Everyone, thank you for joining. Today I'm going to talk about stablecoins, which feels like such a 2025 topic with everything that's going on in crypto. Short introduction of who I am. I'm Raza. I'm the CEO at Scroll. Recently stepped up. Um, this is going to be maybe a bit of a fun talk because the slides will tell a different story that I'm going to tell you. So you can watch the slides or maybe listen to me, up to you. Last year, we launched a stablecoin, which honestly, generally speaking, saying about our stablecoin, it shouldn't be called a stablecoin because what most yield-bearing stablecoins are tokenized money market funds, or they're just a financial instrument that, you know, the underlying assets are invested. There's a strategy, and that's what generates the yield. Of course, we call it stablecoins to avoid like regulatory scrutiny, et cetera, et cetera. And it's decentralized, so that means that hey, it's out there. Use it if you want. Use it if you don't want. If you don't want to use it, don't use it. But we had a thesis where it was kind of like, why is it that these yield-bearing assets or these tokenized forms, so a digital representation of a strategy, was brought to in the form of a stablecoin. And I think that what was really cool is this was more of a way what is understood and communicated, where people don't want exposure to crypto in a volatile way. And then what they got was exposure to crypto in a less volatile way, even though we've seen it this year already a few times, unfortunately. I won't name names, but stablecoins that either depegged or got hacked, etc. There's always risk involved, so it's not as, let's say, volatile or less volatile. But also, where's the yield coming from? And so with a lot of decentralized stablecoins or DeFi stablecoins on chain, what I think is often not understood is the yield is all predicated on one singular thing. The entire DeFi yield is predicated on one singular thing. Does anyone know what I'm talking about? Could you guess? If I had to ask you, where's the yield coming from? One single place. And I will argue with you. I will not let you leave the room. Where does the yield come from? You, make a guess. No. No, no. Governments are losing money. Inflation. No, it's borrow against. So all the yield, everything, if you dial it down, Pando, if you go all the way down, the yield comes from borrow against. If no one borrow against, your USDC doesn't generate yield. So all these vaults or Morpho, all that stuff. If your asset is not provided as collateral and borrowed against, there's no yield. So that tells you that it's a zero-sum game. It's interesting, right? Because so if you look at even if you look at again, not naming any particular stablecoin, if you think about delta neutral strategies and it's essentially longing and shorting and you're hedging. Sure, that is more or less based on speculation, but even then, stablecoins in 2025, a lot of stablecoins came about and said oh, we provide you 5% or 6%, 7%, and then they had all these. It was a circular economy, to say it nicely. To say it less nicely, it's circle jerk. And at the end, if you provide your collateral and no one wants to borrow against it, no one's paying interest on it. If they're not paying interest on it, the rates are low, the yield goes down. That's also why does the yield go up and down? Well, when investors or retail investors lose money, they get liquidated. What does that actually mean? Well, they provided collateral, borrowed against it, and their investment went down. So they bought maybe, I'm slowly going down. Okay. They lost money. So essentially, I bought 100 coins worth $100. Suddenly it's worth $50. I get liquidated. Liquidity vanished. But where did liquidity go? It's a zero-sum game. How do I go back? So we did have a thesis, which is what if you just have one stable coin and you get exposure to everything you kind of want to do with it? So if you want to spend it, which I think is a primary use case of stable coins, I think USDT did a phenomenal job. I've been to Lagos And if you talk to, I mean, it's cringe to say 2026, but it's true. Last year I was in Lagos, spoke with farmers. Most people have no idea that you hold a Nigerian naira and you lose 30% in a week for a farmer and their margin, and then they tell it's like it's outrageous. Like for them it's a game changer. But even for businesses in Europe, where we as Scroll are now going to focus on, you pay. Let's say I'm talking to this fiber optics company based in Paderborn in Germany, and they do 25 million in revenue a year. They pay a few percent in banking fee. Well, if I can provide you a euro stablecoin, that's like 500K a year you save. Well, that's a real use case, right? So we were like, okay, and then as Scroll, we're a ZK chain, so ZK is our bread and butter. We thought we can build a stablecoin that is, you want to spend it, you can spend it. There's yield on it, DeFi yield, so speculative yield. You can get it. We can make it private, so you send me money, I send you money. You don't see the balances, which is like, was a primary concern. And then we make it gasless because we own the chain, so we can make it gasless, so taking that friction away. And we coined the term neo dollar. So these were like sort of like all the, it's still live, by the way. These were sort of like all the features that it had. I still believe in that thesis, but I think that one of the biggest unlock, which you won't read on the slides, was RWA. So I think that, what even yield-bearing stablecoins are. Yield-bearing stablecoins are a form of RWA. Okay, so what is RWA? This is real-world asset. Is everyone familiar with RWA, roughly? Heard about it? RWA? Yeah? Yeah? Are you familiar with RWA? So it's a typical crypto term where it's like RWA and real-world assets, and most people say yes, and they don't actually mean, but it's a very broad term. If real-world assets essentially means, what if in the real world where you have assets, buildings, currencies, anything, and you would put it on chain, that's called RWA, real-world asset, that then comes on chain. The biggest problem with RWA is that you would see an announcement of like, I don't know, a Japanese building worth like, I don't know, $500 million that came on chain. And then we would all like, oh shit, $500 million on chain. Absolutely fucking useless. Because tokenizing assets are only useful when they're liquid. Okay, what's the primary use case of owning assets? So what's the primary use case? If you own property today, if you own gold today, the cringe way of saying it is, what do rich people do with it? Sell? No, rich people never sell their assets. I heard it. Grow? No, not grow. Borrow against it. That's what it is. It's borrow against it. You see what a rich people, like, what one of the richest people did in the world when they wanted to buy a new company? You guys know it if I say it. It was Twitter. And that person, Elon Musk, bought Twitter. How? Did he sell his Tesla shares? No. He found people and said, listen, give me money, and I'll have my Tesla stock as collateral. Very important about real world asset. So what happened is, he went and said, hey, you have $100 million in the bank. I have Tesla assets. Don't want to sell them because they will be worth trillions one day. You're like, that makes sense. So I'm like, give me $100 million. In the case something happens, I'll sell them and give you your money back. But it won't. Give me your money. And you're like, all right, I'll give you your money for 5% on it. And then you're like, well, this asset that you gave as collateral has intrinsic value, so you gave me $100 million. And that's how he bought Twitter. That's why, there's this famous comedian who did a stand-up on it. It's like, a $1 billion transaction, and, you didn't have to, have any cash in the bank for it. So now we come at the crux of it. So you have assets, rich people, what do? They never sell it. They grow it by means of up or down markets. They'll just buy more gold. They'll just buy more whatever. And then the way they leverage it, so the way they extract value from it, is to borrow against it. Okay, so if you have a building on chain, how do you liquidate it? So you see in that example, if I take $100 million from the gentleman and I have Tesla stocks, he knows in the case of like, maybe I default on a payment, maybe like, these shares are trending towards like $90 million before that happens, he can liquidate it and then I can pay him. How do you liquidate a building? So what was the unlock last year, which was, yield-bearing stablecoins or RWA, they're tokenized money market funds or tokenized strategies. How do you put an asset, a real-world asset on chain is by means of tokenizing. Tokenizing means you create an ERC20 on chain or you have other mechanisms. But then you need a custodian off-chain that makes sure that, when this value is like, when I leverage it, I can liquidate the underlying assets to then like even it out. That's why Aave is so popular, right? Because it's permissionless. I provide ETH, I borrow USDC against it. If by some means, like let's say I have one ETH I provided, ETH 2K. Let's say I borrow 2K, you can't, but let's say I borrow 2K. Now ETH goes to like trends towards 1.9. Aave sells my ETH to cover for that position, right? And then settles my debt at a penalty for me, right? So that's like quote unquote automated because there's a liquid market for it. It's able to do this, like a Uniswap pool. It can go like to Uniswap, swap it out. It pays off my debt, no bad debt, like theoretically speaking, right? You can't do that with a building. So the biggest unlock was, next slide, it has nothing to say with my story, but like the biggest unlock was, okay, RWA is real world assets, tokenizing assets. And with the previous talk, Frankencoin, essentially what you saw was the best use case for a stablecoin. So I know Frankencoin, I'm the host of Stable School podcast, and I interviewed one of the members of the association. Some of you were in the previous talk, and what was said, I'm not sure if it was said, is the reason for a Swiss franc stablecoin was to have access to the tokenized securities on that market. That is a real use case. Because today, if you have tokenized securities, and I ask you, how do you buy them? You might be like, okay, with money, but how? Like, what buttons do you press? Where do you go? So you see with a stablecoin, an on-ramp point, and you can go to a platform that they have, and you can buy BOSS shares with that stablecoin because it's paired against that stablecoin. So stablecoins are the gateway to access. But increasingly more so, I'm very, very fond of fiat-backed stablecoins that maintain their peg. And I personally love yield-bearing stablecoins because I come from the finance industry. I have 10 years in banking and insurance, and I think that it's really cool to see that tokenized financial instruments are here. And obviously, for very obvious reasons, we don't call that tokenized financial instruments because that sort of like puts you in regulatory scrutiny. But again, the biggest unlock was RWA. So as Scroll alluded to it as is that I think what is really, really cool is tokenized securities, tokenized equity, and bringing real-world assets on-chain, but not quite, I think, what we see today in the news. So and a very popular asset that comes on-chain is gold. Have you guys heard of it? Do you know a very popular protocol that is doing that right now? They're huge. They're tokenizing gold. You buy gold, it's in a Swiss bank. Yeah, XAUT. They're not the first, but essentially, you buy gold, and there's like a representation of that token of actual gold in a vault in a Swiss bank. How's that different from buying gold on paper? So buying gold in Robinhood. There is a small difference because the security guarantees are higher, theoretically speaking. But I do believe like it is slightly different because it's here. But as far as an RWA asset goes, as long as the asset is liquid, which XAUT is, because it has DEX pools, like you can provide it on Aave, you can like provide it as collateral, and then you can borrow against it, which again like is the primary thing you want to be able to do. Then that's great. So then you can like essentially leverage it, which by the way is the game changer in DeFi. The game changer in DeFi is borrow against, because I'll tell you now, normal retail, and there are like apps like Fidelity that allow it now, borrowing against was not really possible for retail. It's a huge unlock. Normally when you go to a hedge fund or like when you have 1 million Tesla stocks, you need someone, a broker or a bank that is willing to give you the loan. And those loans usually come at like a credit line and a high rate. So Aave is really like an innovation where I was like, shit, I don't need anyone's permission. I can drop it there, borrow against it, and then can you leverage. What most people also don't know, I'm running on time, but is you're essentially trading at the point you're borrowing against. Because if I have 1 ETH and I borrow USDC against it, 1,000 USDC, right? And then you guys have heard of looping and stuff like that. What am I essentially doing? I'm longing ETH. When I have USDC and I borrow ETH against it, what am I doing? I'm shorting ETH. So what most people don't know is it's essentially trading. It's just like non-leverage trading or less leverage trading. So I think that the biggest unlock, so stablecoins, such a 2025 thing. I think the biggest quote unquote thing, prediction as good as any's, is RWA, but not RWA as we've known. So we also have tokenized gold. However, it's different. When you have that asset, you buy it at a discount. So to me, blockchain, I was introduced to it in, I'll be quick, I promise. Blockchain, I was introduced to it while I was doing accounting in a far, far time ago. I was an ACCA qualified accountant in the UK. And I was taught about blockchain. And it's like, I remember the teacher saying, I'm very old, forget about this technology immediately, it's useless. And it was taught in university as supply chain, like it's supply chain, RWA has a huge value proposition because imagine if I could put gold on chain while it's being mined. And then you get to have access to this at a market discount. So now when you buy this token, what it represents is gold in, let's say, before like it's stamped or before the bars are formed. You get to have access to that, which you don't have access to today because you either need like a huge amount of capital, there's political risk, all that stuff. But what if you would tokenize it and then the token would increase in value? So the yield would actually come from not speculation or borrowing against, but the yield would come from economic transactions that happen in the real world. So I think that RWA has huge potential. And I think that there's a lot to expand on. And I think we've already been doing it, but we sort of didn't know or did know. And it's in a specific corner. Very much driven. Personally, I'm very much driven by financial freedom. I think that the coolest thing about DeFi is, again, rich people were doing this for the longest time, borrowing against your asset. They never sold their gold. You guys probably heard this, when you buy it. So again, I'm a little bit older, but in 2010, when I first started my job, I was then I was 20 years old. I bought property, and then that was 8 years of the markets just going up every year, year over year. So I would just remortgage my property, buy some more property, remortgage property. You know what remortgaging is? It's borrowing against. And so you're only limited in your tools when you're retail, because I would love to have borrowed against when I just had $100 worth of assets, because that would have made my wealth grow so much faster. So I think DeFi is insane, and the things that we're building is insane, and the possibilities that it gives, because going from 3-figure, 4-figure, 5-figure net worth, 6-figure net worth is, it's important that you utilize all the tools and you have the infrastructure available, and that's what I think everyone is building. And so, my main point to take away is don't sleep on RWA. If you don't know where the yield is coming from, you are the yield. If you want to talk about RWA or anything ZK, feel free to reach out. Thank you so much. Take questions?
Hello, thanks for the talk. So maybe a very rookie question, because I'm not that rich. Okay, so borrow against, yeah, sure, but at a certain time you repay, right? You need to pay off your debt. How do you do that then, or how does this accrue?
Yeah. So, I'll say it as non-financial advice, but the way we know how economies work is cycles up and down. I'll give you an example. Right now, the S&P 500 is at the lowest in 7-year point of time. So essentially, if there's a general expectation that, let's say, S&P will go up. So what you would do in this situation, what I'm doing in this situation, is I am let's say borrowing against whatever let's say stock I have, and I'm buying S&P 500, right? And then when it goes up, I sell a little bit to pay off the debt, and that's called rebalancing. So in this act, what usually quote unquote rich people do is that they will have. So let's say I'll do the bad case scenario. Bitcoin at 100K, you provide it. You provide Bitcoin as collateral. I borrow USDC against it and buy more Bitcoin, and then provide Bitcoin as collateral again. So I'm essentially saying Bitcoin needs to go up because I have a debt of, let's say, 100K, right? Now Bitcoin is going down. What usually people do is they won't borrow 100% against their Bitcoin. They borrow like 5% and another 5%. And so it averages out until we hit like low in the market, and then just keep it there. Bonus, if you never fully leverage it, on the difference you make interest, which is the premises of Delta Mutual strategy. And so then what happens is bull market comes, boom. So this happens like in a 3, 4, 5, 6 month cycle, right? Now Bitcoin goes like, I don't know, 120K or something like that. That's the moment you're like unwind. So this is usually like done in cycles, and you can do both ways. If you play both ways, you net out always, you can net out like 12, 15, 30%. But the repayment happens the moment you make a profit. How much of it determines on your risk management and determines on how much you want to make. But there's always risk involved. Like borrowing against, like, sounds like a magic solution. It's not like a magic solution. Is just like you need to make sure. And so you can't do it with everything. You believe that the asset you're collateralizing has intrinsic value, number one. Number two, you play according to cycles. That's the TLDR.
Usually stablecoin usually equals low risk, right? When I see yields of 12%, imagine we're at a first year econ class, and they always tell you the higher the yield, the higher the risk. So if you're offering a product with very, very low risk, how can you then offer a 12% yield, which in any real world business, not real world business, would be considered extremely high? How would you answer that to a first year econ student?
So I think risk is subjective. So risk is really like losing $100 is high risk to you when you have $100 in the bank account. Losing $100 when you're million is less. I also think that it's ironic that you say 12%. By the way, I agree with you what you're saying right now. But 12%, like I said, when I came up and about 2010, we did year over year, like, I don't know, 20, 30% for like 8 years. It was nuts. So like those were the, like, I feel for young people. The way I explain it is exactly the same way. Is that number one, in the stablecoin space, we have a huge issue of ratings. There are no ratings. S&P is, not S&P 500, but S&P is trying to come up with something. Number two, that's exactly how I'd explain it. The higher the risk, the higher the yield, the higher the risk. And number three, you need to. That's why I started my story with, like, you need to understand where the yield is coming from. So even 12%, no one is actually, like, when they say 12% or 50%, it's usually up to, because it fluctuates. And honestly, this, not to deviate your question, the biggest risk to me when it comes to anything DeFi really, and you saw it very recently, again, I won't name their name, is when someone leaks their private keys, when there is a hack. That to me is like a much far bigger risk. It's like, I might market, I don't know, 20 or 30%. The actual yield paid out is what really matters. That might be lower, right? But one is like, what does your underlying asset have exposure to? Two is, unfortunately, with all things crypto, you're exposed to bigger risks that people are, like, not aware of. Does that answer your question?
Still very high risk, 12%.
Yeah.
If government bonds, you get 2% because you think you'll get your money back. You're willing to go to 12% if the risk is much higher, right?
Well, I mean, like, I think, oh man, it's no one better be recording. But like, when you say that, like, I think that's far more riskier because you net out losing money because of inflation and you don't know it. So it's like, when you talk about losing money, it's like, man, you're losing money, you don't even know it. That's like the worst thing ever. So, yeah, like, but I think the scariest thing of working in crypto is like, I have pager duty. That means that when that thing goes off, and I have 4 kids. So it's we're at the frontier. The crazy way of saying is we're in the Wild Wild West, but I like to think we're at the frontier. And I think what I think is really, really cool is that this borrow against mechanism, to be able to have provided that to like normal people, I think is a huge unlock. Baseline, I agree with you. What you're saying is that there is a significant risk involved, and people should educate themselves and be aware. Thank you, guys. Thank you. I appreciate it. Thank you.